Hi friends, my name is Rahul Jain. I'm a SEBI registered research analyst. Something very interesting happened in the month of March 2026 for stock market investors. In this month, Nifty fell by almost 11.31% in just one single month. And if you go back to last 6 years of data, you will find that this only happened back in March 2020 during COVID time when Nifty fell by around 23%. Since then, if you look at the monthly returns of Nifty 50, you will find that March 2026 was the worst month after the COVID period. And this March 2026 will be remembered by stock market investors because of US-Israel-Iran war. Nifty 50 tanked by almost 11.31%. Now the reason I'm talking about March 2026 is that there was a sudden change in the mutual fund investors after March 2026. Let me give you very interesting data point. What you see on my screen is the month of April 2026, meaning 1 month after this heavy correction happened in the stock market, what happened was something very interesting. Look at this data and you will see that multi-cap mutual fund category in the month of April grew the fastest. All of a sudden, the AUM, the asset under management for multi-cap category grew by almost 27%, meaning a lot of mutual fund investors started to put their money in the multi-cap mutual fund category as compared to small cap, mid cap, flexi cap from a growth perspective. If you look at small cap only grew by 9.9%, mid cap 8%, flexi cap only 0.9%. Large and mid cap, actually the inflows were lower, 15.4%, and large cap lower by 15.8%. So all of a sudden, multi-cap mutual fund category became the popular category in the month of April 2026. Now I don't know whether this trend is likely to sustain or not, but one thing is very clear in my mind as a mutual fund investor, that is that multi-cap mutual fund category is a magical mutual fund category in the sense that it gives the genuine diversification to the mutual fund investors. Why? Because SEBI in September 2020 mandated that every multi-cap mutual fund category has to have minimum 25% in large cap, next 25% in mid cap, and 25% in small cap as a minimum. The remaining 25% can be allocated by the fund manager depending on his skills, his thinking process, whatever. But at least minimum 25% has to go to large cap, mid cap and small cap. And that makes multi-cap mutual fund category genuinely diversified by market cap. Now the natural question is that, Rahul, what are the best multi-cap mutual funds that I know of? And I can tell you that this video will tell you something very interesting about mutual fund selections. Okay. And in particular, I'm going to take multi-cap mutual fund category as a reference point and will teach you few very important concepts. Before I start this, I want you to tell me in the comments, as per your research or as per your portfolio, which is the best multi-cap mutual fund. Pause this video, let me know in the comments. And also let me know what is the reason that you say a particular mutual fund is a best multi-cap mutual fund. Okay, it'll be very interesting for me to understand what your logic is, what your thought process is, because that thought process is likely to be changed in the next few minutes, because I want you to understand that returns, the past returns is not the only criteria that you look at. Of course, past returns is important, specifically the average rolling return. I talked about average rolling return in one of my Hindi videos, Achhe Mutual Funds. If you have not watched that, please watch it. It will tell you exactly what is the meaning of average rolling returns that a lot of people don't even know. Okay. Anyways, coming back to this video now, let me break it down step by step in terms of how do you approach a category like multi-cap mutual fund category. And this will truly teach you a lot of new mutual fund concepts. And if you like this video, request you to hit the like button. Let me know in the comments a simple thank you. It motivates me to do a lot of research for you at zero cost. With that, let me break it down for you. What you see on my screen is around 32 multi-cap mutual funds. Okay, and I've arranged them in the order of when these multi-cap mutual funds were launched. As you can see, top 6 mutual funds here: Quant, Invesco, Nippon, Sundaram, ICICI, Baroda, PNB. They have spent almost 162 months in the market, meaning around 13 years. Now, a lot of people go and blindly look at the past track record of 10 years, 15 years, 13 years of returns data of these mutual funds. But that is a very big mistake when it comes to multi-cap mutual fund category. Why am I saying that? Because if I show you the SEBI regulation that started in September 2020 on the multi-cap mutual fund category, that is when the multi-cap mutual fund category was created, in the sense that SEBI enforced 25% in large cap, 25% in mid cap, 25% in small cap. Prior to September 2020, many of these multi-cap mutual funds were not truly diversified by 25%, 25%, 25%. Therefore, comparing their performances before September 2020 could be very, very misleading because these mutual funds may not be following this 25, 25, 25 allocation. Hope this point is very, very clear that do not just blindly go and look at the last 8 and 10 years of track records and try and look at that data. Okay. Having said this, we are going to look at 3 years average rolling return data that is giving you the consistency over a 3 years average rolling returns perspective. So if I filter these funds out by 3-year average rolling return highest to lowest, you see on my screen Kotak, Axis, HSBC, Nippon, LIC, these are the top 5 mutual funds. Now here is an interesting point that you would note that out of these 3-4 funds, if I look at Kotak, Axis, HSBC, Nippon, if I look at these top 4 performing multi-cap mutual funds from an average rolling return perspective, what you note is that Kotak is only 58-month old, okay? Axis is around 55-month old, HSBC is around 42-month old, meaning that these mutual funds which are around 3 to 4 to 5 years old only, they have given that performance. And anyway, September 20 to now, if you look at it's around 5.5 years of time period that truly multi-cap mutual fund category has been created. The only fund that I see here which is 162-month old still appearing in the top 4 is Nippon India Multi-Cap Fund. Again, I'm going to talk about a lot of details about these mutual funds, but hope this important concept is very, very clear that even if we remove the timing in terms of how old these funds are, if you look at 3-year average annual rolling returns, Kotak is number 1, Axis is number 2, and HSBC is number 3, followed by Nippon. Now, what I really want you to understand is that out of these 4 mutual funds, how do we go and make a distinction that which are the better mutual funds for your portfolio? Okay, let me walk you through few important parameters that nobody is talking about that you need to learn here. So the first thing we will do to study these mutual funds is to look at the nature of these mutual funds. Are these mutual funds defensive or aggressive? Okay, how do we do that? So for example, I've gone to all of these mutual funds fact sheet. Fact sheet is a very, very important document that every AMC publishes on a monthly basis. You can find that on their website. So for example, I've opened here Kotak's multi-cap mutual funds fact sheet. Now, if I come down here and show you how much is their allocation in terms of large, mid and small, you can clearly see that they are heavily tilted towards large cap. Large cap is around 41.9%. Okay. Now, if I show you Axis mutual fund here, have a look at Axis. This is also showing me large cap as 44.40%, remaining mid cap, small cap and cash and others, right? The third one, if I show you, which is HSBC multi-cap mutual fund here, if I come down here, we have a look at the large cap. Large cap is around 42.11%, small cap around 27.36%, mid cap around 26.96%. So meaning that this is also heavily tilted towards large cap. Okay. But still all 3 mutual funds have maintained minimum 25, 25, 25, right? Now have a look at the fourth one, which is the Nippon. And if I talk about Nippon here, you can see that there also large cap is around 44.94%, mid cap is 28.7% and small cap is around 26.31%. Okay. Meaning that this is also heavily tilted towards large cap. Now there is nothing wrong in that. What is it telling you is that all these 4 mutual funds are slightly defensive when it comes to multi-cap category. Now as an investor, you have to decide whether you're okay with this or not, because you might say that, Rahul, I want to go a bit aggressive. I want to go for higher small cap and mid cap allocation. So I come back here and I look at my screener and have a look at the mutual funds that are highest in small cap holding, okay, within the multi-cap. So you will see funds like Samco, SBI, DSP. And if you look at these mutual funds performance in terms of the 3-year average annual rolling return, whichever mutual fund have completed 3 years, they haven't done well. For example, SBI, 19.14% is the average rolling return. Kotak, HSBC, Axis, they have done much, much better, right? If you look at Quant Multi-Cap, that has got small cap percentage, which is very high, 33.72%, has given 15.96% average rolling return. What is the point here? Point is very, very simple. A lot of people think that just because having small cap and mid cap should allow the mutual fund to give better returns. That is not the case necessarily. I've proven it in front of you, right? So first thing is you decide whether you want to go aggressive and defensive. That is the nature of the mutual fund versus what is your risk appetite, right? Now let's say all these 4 mutual funds that we have talked about, which is Kotak, Axis, Nippon and HSBC, they are heavily tilted towards large cap category, right? But what about their performance? Now this is where the next level of filtering comes into picture. Okay, so I'm going to walk you through 3 or 4 important parameters. Number 1 is the standard deviation, which is how much the returns fluctuate in that particular mutual fund within that mutual fund. Okay, it is not looking at any reference from outside. Within the mutual fund, from the mean return, which is the average return, how much it fluctuates by, which is the measure of volatility. Okay, so have a look at Kotak, right? Kotak's standard deviation is 17.86%. Okay, if you look at Axis here, Axis standard deviation is less, 16.04%. Okay, if I talk about HSBC's standard deviation, if I come down here and show you, it is 17.70%. So meaning out of the three that I've talked about, Axis has the lowest standard deviation. Kotak and HSBC, they are showing higher standard deviation. And if I talk about Nippon here, let me go back to Nippon and talk about the standard deviation here. Here the standard deviation is lower than Axis as well, 14.99%. Now why this is important? Because if you are a mutual fund investor and all of a sudden you see that within a month or 2 months time period, the returns are fluctuating a lot, then you might not like that mutual fund. Okay, so always look for those mutual funds that have lower standard deviation but still are giving better rolling returns. So in this case, that will be Axis as well as Nippon. These two mutual funds from that perspective has done well as compared to Kotak and HSBC. We have seen the data. And this data point that I am talking about, why am I showing you from the fact sheet? Because the fact sheet can show you the latest and the accurate data point that the AMC has published. That's why I've done a lot of work for you and I've gone to individual fact sheet to pull this data, right? I'm showing you the screens here. The second parameter that we look at is the beta. What is beta here? Beta tells you that how much sensitive a mutual fund is with respect to the broader market. If the market falls by 10%, how much this mutual fund is likely to fall by? That is the measure of volatility with respect to the market. Standard deviation was within the mutual fund itself without looking at any other outside reference. But beta is looking at the outside reference, which is the broader market. Okay, because if the broader market corrects by, let's say, 10% and your mutual fund corrects by 20%, it tells you that your mutual fund is very, very volatile as compared to market conditions, right? So have a look at the beta here. So for example, Kotak's beta is 1.04, meaning that it is more sensitive. It is likely to fluctuate more than the market. Okay, if the beta is more than 1, it is more fluctuating than the market. Okay, very simple language I am trying to tell you. If you look at Axis here, what is the beta? 0.93, meaning that it is less sensitive as compared to market. Okay, which is very, very good thing in my view. If you look at HSBC, the beta is exactly 1. Okay, so whatever market fall happens, then HSBC is likely to react to that as per the past track record. Now, if I come back and show you the Nippon, let's have a look at Nippon as well. Nippon's beta is 0.89. So from beta perspective as well, if you look at these 4 mutual funds, then we look at Axis, which is less volatile, less than 1, as well as Nippon. These 2 mutual funds have fallen less as compared to the broader market, right? So this is second important criteria that you need to look at from a volatility perspective. Now comes the most important parameter, which is Sharpe ratio. What is Sharpe ratio? Sharpe ratio tells you the risk adjusted returns. If you're taking 1 unit of risk in all these 4 mutual funds, which mutual fund have given you the best returns for that 1 unit of risk? That is what we need to know. Let me show you the data for Sharpe ratio now. So if you look at Kotak's Sharpe ratio, it is declared as 0.95. Anything which is lower than 1 is not considered great. Anything which is higher than 1 is considered good or optimal. Okay. So here Kotak-Multicap Sharpe ratio is around 0.95. What about Axis? So have a look at Axis here. It is around, Sharpe ratio is exactly 1, which is decent in my view. If you look at, for example, HSBC, here the Sharpe ratio is 0.93, which is lower than even Kotak. If I now talk about Nippon, Nippon's Sharpe ratio is around 0.70, which is lower than even Kotak. So from a Sharpe ratio perspective, worst is Nippon, best is Axis, followed by Kotak, and then third number HSBC, and final number is Nippon. So this is how you have to look at the Sharpe ratio as well, because it is telling you the risk adjusted returns given by the mutual fund. And Axis number 1, number 2 is Kotak, number 3 is HSBC, and number 4 is Nippon. Now you have looked at various parameters here. You have looked at the average rolling returns, right? So let me try and go back to the screen here and show you the average rolling return perspective, which was the number 1 Kotak, number 2 Axis, number 3 HSBC, number 4 Nippon. But when you dig deeper beyond the average rolling return, you also look at the volatility, because average rolling return is telling you the end output. But it is not always about end output. You have to look at the journey as well. How is this journey going to be? Am I going to see a lot of drawdowns? So for example, if I talk about the maximum drawdown, which is the maximum fall from the last peak to the lowest bottom, if you look at that, Kotak has given around 21%. So at one point in time, it was down by around 21% from its peak. Now ask yourself, will you be able to hold this particular mutual fund if it is down by 21%? That is the question you need to ask, because a lot of people right now will go and sell off their mutual funds in losses or will stop their SIPs. Why? Because the mutual fund is down, market is down. Some mutual funds are down by 25%, 23%, 30% and whatnot. My point is that this is also very, very important parameter that investors are not looking at. Okay, and I want you to look at these parameters. So Kotak is 21%. Axis maximum drawdown is 18.08%, which is lower than Kotak. HSBC is 20.07%, which is higher than Axis but lower than Kotak. And lastly, Nippon is 42.75%. Why Nippon's maximum drawdown is 42.75%? Because we now know that this fund is a very, very old fund. It was prior to COVID, and during COVID time period, a lot of damage happened in the Indian stock market. That is why this is sort of exceptional criteria here. Okay. Now coming back to the parameters now. So we looked at the 3-year average rolling return. We looked at the top 4 funds. Within the top 4 funds, we looked at Sharpe Ratio. We looked at the standard deviation. We looked at the beta. We looked at the maximum drawdown. We looked at their allocation, which is the large cap, small cap, mid cap. These are the minimum 4-5 parameters that you need to look at, and it's not only applicable to just this mutual fund category. You can go and put these criteria for any other mutual fund category, right? Now let me know in the comments, out of this analysis, I've talked about these 4 mutual funds. Let me know which one according to you is a better multi-cap mutual fund. I want to really know what is your answer based on this analysis. None of these mutual funds are recommendation from my end. My intent has been that I teach you advanced mutual fund filter criteria so that you just don't look at the past returns. You look at these parameters as well. Look at how many number of stocks are there, what is the large cap, mid cap, small cap allocation, etc. And then make an informed decision and stick with that mutual fund for at least 2 to 3 year minimum, so that you can understand whether that mutual fund is working out for you or not. Now, if you want me to create any other mutual fund category related videos, let me know in the comments. I've done this multi-cap now. I have also done in the past flexi cap as well. If you want me to do mid cap, small cap, etc., let me know in the comments. Based on your comments, if I get, let's say, 1000 comments in this video and the maximum comments on a particular category, I'll then come out with more videos for you. I hope you like this video. I'm going to see you in my next video. Until then, keep rocking.